What are central banks and how do they factor into the Forex market?
Central banks serve as the primary monetary authorities within their respective countries and are tasked with regulating the financial system and managing the money supply to achieve specific economic objectives. Their actions have far-reaching implications, particularly within the Forex market. Let's now delve deeper into what central banks do and how they affect the FX market. Central banks formulate and implement monetary policies aimed at achieving objectives such as price stability, full employment, and economic growth. The key tools they use in monetary policy include setting the interest rate, reserve requirements, and open market operations. And so changes in these policy levers can significantly impact currency values and FX rates. Interest rates set by central banks directly affect borrowing and investment returns, making them a crucial factor for currency valuation. When central banks raise interest rates, it tends to attract foreign capital inflows seeking higher yields, and because the FX market is determined by supply and demand, higher demand strengthens the currency and usually raises the price. Conversely, lowering interest rates may stimulate borrowing and spending, but can lead to currency depreciation as investors seek higher returns elsewhere. In times of economic downturn or deflationary pressures, central banks may resort to unconventional monetary policies like quantitative easing. This involves the bank purchasing government securities or other assets to inject liquidity into the financial system. QE programs can influence currency values by increasing the money supply and potentially weakening the currency. Central banks can intervene directly in the FX market to stabilize or influence the value of their currency. This can involve buying or selling their own currency in large volumes to counteract excessive volatility or speculative pressures. Central bank announcements and speeches by policymakers often provide insights into future monetary policy decisions and economic outlook. Forex market participants closely monitor these statements, analyzing them for clues about potential interest rate changes, policy direction, or shifts in economic conditions. Anticipation of central bank actions can lead to significant volatility in currency markets as traders adjust their positions based on their expectations. Import the BlackBull Markets calendar to your email to receive alerts about upcoming economic events in your inbox, enabling you to plan your positions in advance and seize trading opportunities. Follow the link in the description to get started.